Risk and return. The expected return is calculated by summing up the return of each scenario of an investment multiplied by their probability of giving that return. You can also use historical return to calculate the expected return, but the actual return might vary greatly from historical return when there are changes in the unsystematic risks, like new products, new competition. The risk of an asset is expressed by variance. Variance is the measurement of the spread from the expected return. The higher the spread, the riskier is the investment. Variance is calculated from the spread from the expected return. Those spreads can cancelling out each other and give variance value of 0. So to avoid variance to be 0, we convert the data to a squared form before calculating variance. Standard deviation is the square root of the variance. This is to convert the data back to the same scale as it was originally started with. Standard deviation is most common amongst traders and analysts to use. Let's calculate the expected return and variance. Here is an investment with 3 possible outcomes. The probability of each outcome is 50% for scenario 1, 20% for scenario 2, and 30% for scenario 3. The return of each scenario is 10% in scenario 1, 5% in scenario 2, and 20% in scenario 3. The expected return is calculated by multiplying the probability of each scenario with their respective return and sum up the results. This gives the expected return of 12%. Variance is calculated by adding together the squared value of the spread between the return of each scenario and the expected return, and multiplied by the probability of each scenario. It's better to see the calculation in practice. You take the return of each scenario minus the expected return, rise by 2 to get the square value, multiply by the probability of that scenario. And you sum up the results. This gives the variance of 0.0031. Standard deviation is the square root of the variance. This gives standard deviation of 5.57%. Assuming the returns follow a normal distribution, the result tells us that 68% of the time, the return will spread one standard deviation from the expected return, either positive or negative. So 68% of the time, the return will be between 18% and 6%. 95% of the time, 2 standard deviations. %, of the time, 3 standard deviations. So 95% of the time, the return will be between 23% and 1%. 99% of the time, the return will be between 29% and minus 5%. Now let's do the previous calculation with a stock. Here we have closing prices of Apple on the 1st of June each year from 2008 to 2018. The data is from Yahoo Finance. Since we don't know what Apple's future scenarios are or the probability of the scenarios and their returns, we will use the historical stock price to compute the expected return. This is calculated by finding the average yearly return. To calculate the return for any given year, you take the price of that year over the price of previous year minus 1. We drag the formula down to calculate the rest of our data. Now we take the average of our returns. This gives us an arithmetic return of 31.9%. The number will come in handy later when we are calculating variance and covariance. For an investor, the arithmetic mean isn't accurate as the expected return because it doesn't consider the compounding effect. Compounding effect is when you reinvest the return from the previous years. Also, using arithmetic mean as expected return doesn't account for gaining back the loss you might have had from the previous years. Thus, we will be using the geometric mean to find the more accurate yearly return. To find the geometric mean, we add the number 1 to each year's return. This is so we can get the interest factor from each year's return. For example, in 2009, we had 3% return. This gives 1.03 interest factor. We multiply the result like this. We raise the result by 1/10 because we want to find the yearly return from a 10 years compounded return. Minus 1 to convert the data back to what we started with. This gives geometric mean of 28.3%. Excel also has a formula to calculate geometric mean. The input range is this range, also minus 1. This gives geometric mean of 28.3%, same result. Do you remember how to calculate variance? We take the return of each year, subtract by the arithmetic expected return, all in a square form to avoid turning variance to 0. Since our dataset is quite large, we will be using Excel formula for this. Our dataset is considered a sample from a population, so we will be using this formula, variance point S. S stands for sample. This gives variance of 0.096. Standard deviation is the square root of variance. The standard deviation is 31%. So in this video we have gone through how to calculate the expected return, variance and standard deviation, and we have gone through how to use the historical return as expected return. Remember that the actual return can vary greatly from the historical return, and how to calculate the geometric mean. On the next video, we will be adding stocks and construct a portfolio.